Hey, it's Jim, and this is level 3 of the CFA program, the topic on ethics and professional standards, and the reading on guidance for standards 1 through 7. We're now on standard 6, conflicts of interest. Let me quickly give you some examples here. In standard 6A, the classic example is way back in the old days, maybe before the 1980s, where boards of directors consisted of the chief executive officer and the chief financial officer and the chief operating officer and other kinds of operating officers. Remember that the board has essentially two functions. The first one is to establish the strategic direction of the business. Second one is to hire and fire the executive leadership team. Well, hopefully you get this immediately. That the board consisted of internal employees, so it was their job to hire and fire themselves and each other. This was a tremendous conflict of interest. And by the way, it's amazing how well it did work back in those days. But we typically have lots and lots of independent directors now, so that conflict is generally been avoided. And we have a couple of good slide decks about the board of directors. Priority of transactions, there's a really cool example inside of this learning module in which there's a wealth advisor who has her parents as clients, and there's an IPO or some equity offering. And in the paragraph, we're told that the wealth advisor distributes the IPO to all of the other clients and waits to include her parents until the very end. Was this a conflict? And the answer is yes, because her parents were paying customers and paying clients, that she treated them differently. And so this is the subtlety that the Institute loves to ask on the exam. And then referral fees, there are 5 examples inside of this section. And all but one, there is a violation of this standard. And the violation of the standard is every time because the analyst or the wealth advisor did not disclose the referral fees to everybody out there that's important. So that's a quick summary of what we're going to be faced with this relatively short slide deck. Once again, there are the LOSs that we've had for all 7 of these. So let's go back to this beginning part of conflicts of interest. And the Institute is fully aware that life is not perfect. We have relationships. We have parents. We have children. We have cousins. We have friends. We have colleagues. We have people we met on the airplane. We have all sorts of potential conflicts of interest. So the Institute is not asking us to be perfect and avoid all these things. The Institute says, look, you're going to have these conflicts. Make sure that you're do not allow that conflict to influence your investment recommendation or any kind of behavior. And if you reasonably believe that it will, well, then just back away and say, you know what, I can't be a part of this. But the second part of the coin here is that we need to make sure that we tell everybody. Avoid or disclose conflicts. Prominent, delivered in plain language. Yeah, that makes perfect sense. So what are the possible sources of conflicts? Compensation structures, incentives, and bonuses. And there's an example about stock options. Of course, you don't have to have direct ownership inside of a company, whether it's a share of stock or maybe preferred stock or even a bond. If you have indirect ownership with a stock option, then this, of course, is part of this source of conflict. Now, if you directly own shares of stock in a covered company, then, of course, you're going to be tempted to issue a favorable report, because if you issue a report and say, hey, this company stinks, stock price falls, well, then your spouse is going to look at you and say, what are you thinking? What are you thinking? I wanted to build a swimming pool in my backyard. Now we can't do that. I'm always fascinated by watching all the news reports, financial news, when an analyst or a wealth advisor comes on and they'll make these disclosures. And I'm always so happy that I hear about these disclosures. I never really pay attention to what they are, but I'm happy that they disclose them. And so I think this is probably one area where the Institute has had a tremendous influence in the industry. All right, disclosure of conflicts to employers. There are a whole bunch of example problems inside of this learning module. A couple of them have to relate to conflicts with employers because, of course, we have lots and lots of skills. There's an example in there in which someone donates some of his or her time to a nonprofit and says, you know what, I'll go and I'll do whatever it is. I can't remember the exact part of the question stem. And they're not being compensated. They're donating part of it. And so is this a violation? Well, you know, I've said this before, is that if there's ever any confusion, just go to the compliance department and say, hey, this is what I'm doing. Do I need to formally disclose this? Just make people aware. You don't want to hide anything, right? You don't want to open up the peach basket and see some rats or dirt or spiders or whatever else that you're afraid of. What's the problem here? Ability to render unbiased investment advice, parallel professional service, affiliated with a subject company. Of course, we're not acting now this is directed to the employer in the employer's best interest. And then we have the parallel example, disclosure of conflicts to the client. Notice the best practice here is just to avoid them. However, there are going to be conflicts, as I was saying just a few moments ago. Make sure that you disclose them, including family ties, relationships with banks and the firm, any kind of beneficial ownership. Remember that beneficial ownership, that's some kind of indirect ownership, which could mean lots and lots of things, including some option securities. Now, I think back in the old days, we used to, when I was going through the program, we called this, some kind of a wall, some kind of a firewall. I always use the example to my students, and I'm going to give you a silly example here. I'm guessing you guys don't know who Fred Flintstone and Barney Rubble are, but this was a cartoon that I used to watch when I was a kid. And one day they had a fight, and they built a big wall in between their houses. They were next door neighbors. So when I think of cross-departmental conflicts, I think of Barney and Fred, and they built a wall so they didn't have to see each other, they didn't have to look at each other. And so the best practice here is to build the Fred Flintstone wall and just make certain that there is some kind of a system or a process or a protocol that when the two people talk to each other, when Fred and Barney finally talk to each other, that they avoid talking about, whatever is this conflict. There's your homework assignment. Go watch an episode of The Flintstones. Here's a specific key area of note with stock ownership. And so the best thing that the firm can do is say something like, you know what, if you're going to cover a firm, just don't have any ownership in it. I go back to politicians and government leaders who say things like, you know what, I just have the S&P 500 index or the Wilshire 5000 index or the total stock market index, and I get it, Procter & Gamble is in there, but it's a small fraction, and I own some small fraction of Procter & Gamble, but that shouldn't preclude me from covering Procter & Gamble. Now, of course, not everyone's just going to own that index. They're going to own actively managed mutual funds, or they're going to identify over or undervalued stocks and have those as part of the portfolio. So look at the orange arrow point there. The best practice is just to prohibit members from owning securities that they own. That they're going to cover. And that's probably restrictive, but if you do, make sure that you disclose that ownership and include immediate family members. Now, I'm not sure what the Institute thinks about what immediate family members are. Clearly, if this were me and I had my family, my immediate family, my nuclear family that has lived in this household, that would be part of it. But I'm best friends with my cousin. Should I include my cousin in this? From my perspective, remember, the Institute, all they want us to do is be reasonable. So yes, Yeah, I would include my cousin. Now, how about my aunt who lives all the way across the country and I speak to her once or twice a year? Probably not. Here's that slide I was telling you about earlier. So with conflict as a board member, we have the duty to the shareholders. This is what I was saying about those two roles. We also are going to be paid. Of course, we give our expertise and service to the board. We're going to be compensated for it. And then the final thing in here, and this goes back to another learning module inside of the standards. Of course, if we have non-public information, and remember what we said during that learning module is that whenever you think that you have access to private material, non-public information, and of course, if you're a board member, this is going to happen pretty regularly. You have a responsibility to tell those other board members or the executive leadership team or whoever it is to say, you know what, this is private information. You ought to go out on the steps of the building and just get a megaphone and shout it out and say, hey, we're thinking about taking over this other company over there. Of course, it probably doesn't work that way. Yeah, here's that word firewall as well. Remember, when you're on the board, you either volunteer or are assigned for various subcommittees. And the assignment or the service on those subcommittees can lead to additional conflicts of interest. And so, if you're an accountant on the board, you're probably going to be on the audit committee. That makes perfect sense. If you're a wealth advisor, you're probably going to be on the compensation committee. That makes perfect sense. But what you are likely to do here, and best practice, is for you as the wealth advisor not to talk to the accountant so that you don't have any cross conflicts. Let's end this section with a good question here. We've got Jeffrey, premium brokers. Axion has approached Clark to promote its publicly traded stock, offers a higher than average commission for each stock sold to Alliance premium brokers clients. So, hey, this sounds good. Hey, good for Jeffrey, right? We all want to be the LeBron James of the financial services industry. Of course, if we're LeBron and we play for, how long has he played? 20 years, 22 years by now, however long it is. We want to be compensated. So this is not a bad thing. Ensures all his clients and the firm's compliance department. That sounds good. We like that so far. Made aware of the additional compensations with an email communication. So, back in the old days, written communication meant, you'd get a pencil out and you'd write it down and then you'd sign your name in ink. But nowadays, written communication can take lots of forms. Email communication is perfectly fine. Is Clark compliant with this? He has disclosed the nature of his compensation. No, he's recommending stocks. That creates a conflict. No, because compromises his independence. But this sounds like all this is good stuff, of course. Yes, he fully disclosed his additional arrangements. All right, priority of transactions. We need to make certain that we don't ever put our own or our friends or our husbands or wives or our children's trades in front of clients' trades. So let's start with a good question here. Here we are, a portfolio manager planning to sell a portion of personal investment portfolio. He wants to sell his holdings of household products, but his firm recently upgraded the stock to a strong buy. Which of the following describes Rose's options? All right, so what does this mean? We're a portfolio manager. We have a personal investment portfolio. We have a liquidity event, right? Child's academic tuition. Does that mean that we can't sell? Probably not. Remember, but what we can't do is we can't do it before somebody else. All right, so what are our choices here? Rose cannot sell the shares because he would be improperly prospering from the inflated recommendation. Rose is free to sell once his firm is properly informed. Oh, we like that one. Can sell his personal holdings, but only when a client of the firm places an order to buy the shares of the household. I don't like part C at all. That doesn't make any sense, right? So B is the correct answer. Free to sell his personal holdings once we're all informed of the intentions. All right, so here are the highlights here. Avoiding potential conflicts. Yeah, so the clients are not disadvantaged and the member does not personally benefit, and we have to follow all relevant laws and regulations. Yeah, this standard emphasizes that the client and the employer transactions come before all personal accounts. That makes perfect sense. Now, how about a standard for non-public information? If we have knowledge of pending transactions, so think about it. Suppose that we have a client that comes in with a wheelbarrow full of money and says, I want to invest all of this in shares of Jim's Concrete Company. And so by the time you count all the money out, right, and then you put together the policy statement for this client, some time has passed. So there's going to be a huge order and the people on the floor of the New York Stock Exchange are going to bid the price up. So you cannot say, hold everything and then go back to your office and buy shares, either for yourself or for your employer or for any of your clients. Pending transactions. Here's another highlight on beneficial ownership. Of course, we can have spouses that buy shares of stock. We can have children that buy fixed income securities, but we need to make sure that all of the clients out there and the employer has a chance to go ahead and act on the recommendation. Now, there's a good exam question inside of the handbook about this second teardrop point. Family accounts that are client accounts should be treated like any other client account. All right, recommended procedures for compliance. Encourage their firms to develop policies. We see this throughout all of the standards. There's a must disclose these policies. And then, of course, what the Institute is particularly concerned about is initial public offerings, mostly because, there are lots of firms that issue their stock at $20 a share. And then 10 seconds later, after trading begins, they're $1,000 a share. And so there's always the scrutiny of those kinds of transactions, especially by journalists from the Wall Street Journal that come in and say, all right, who are all the people that bought it $10 or $20 a share? And then as soon as the price got to $1,000, were those the same people that sold? So IPOs are a good topic for exam questions. Restrict private placements. This is the same thing, imposing blackout and restriction periods. This prevents the front running. And then establish reporting requirements. And so this is disclosures. This is relationships between and among any of our third parties or brokers. And then pre-clearance procedures on personal trades. That makes sense. And then the Institute also wants us to disclose policies regarding personal trading to clients upon request. So we don't have to have that publicly available all the time, but we need to do this. And notice, outlined in simple language. You don't want to put a report that's 75 pages. Let's go ahead and look at a good question under priority of transactions. So here we are, senior trader. We've helped our sister open a standard fee-paying brokerage account. One of our investment banking clients is set to go public in the next few weeks through an IPO. So this is what I was saying just a moment ago about the importance that the Institute attaches to initial public offerings. And there's probably a good IPO question in every one of the 7 standards. All right, so what are we faced with here? What action would most likely violate? Not least likely, but most likely violate. All right, so taking no action and allowing her sister's account to be treated like any other standard fee-paying account. Well, that makes perfect sense that this is the best practice and that this is not going to be a violation. Increase allocation to her sister's brokerage account. Well, boy, that sounds like something that we've talked about, not just inside of this video, but a bunch of previous ones. So B is probably a violation. How about C, failing to disclose a family relationship to the compliance team? Well, That sounds like a violation too, but that's a violation going back to Part A, not in Part B, priority of transaction. So the correct answer here is B, increasing the allocation. All right, how about the last one here? Referral fees. Let me give you just a quick example here. I'm embarrassed to admit that I put together my own tax return in April every year. That's just because I want to keep track of all the stuff. But then I take it to a local accountant, and she goes ahead and makes certain that I do the math right, and then she files electronically and does my state return as well. But what I could do is I could say to her something like, hey, you know what? Next time you have somebody that come in here that has a bunch of money, why don't you refer them over to me, and I'll go ahead and manage their lifetime portfolio or their retirement portfolio or whatever it is. And I'll give you X number of dollars or X percent of whatever I charge them. So what do I have to do? Of course, this is okay, but then I need to just make sure that I disclose this to really anybody that's important. What does the Institute tell us? Look at the very bottom, the employer, clients, prospective clients as applicable. Yeah, why is this disclosure important? You don't need me to read that to you because we've talked about this before, right? So let's go ahead and start with a question. What is the following statement is a purpose of disclosure in the referral fees? All right. Disclosure will allow the client to request discounted service fees. Well, that doesn't make a whole lot of sense, right? The client can ask for almost anything. The client could say something like, here, will you do this for me for free? And we could probably say no to that. Disclosure will help the client evaluate any possible partiality shown in the recommendation. Now, that sounds like something that we are wanting to make sure that we do, right? Part C, disclosure means advising a prospective client about the referral arrangement once a formal client relationship has been established. So this is the whole thing about clients and prospective clients. We need to treat them identically. So the correct answer there, disclosure will help the client evaluate. All right, two parts here, when the member receives a referral fee or when the member pays a referral fee. So when we're receiving the fee, we need to make this disclosure before the investment. When we pay the fee, we want to make sure we disclose it when the actual fee is paid or whatever that other compensation. Recommended procedures to be in compliance. Once again, we want to make certain that we urge all of the people around us, including our supervisor and the employer, to establish a formal procedure regarding referral fees. What we can do is completely restrict such fees or outline procedures for requesting approval. All right, let's work through a final example here. Portfolio manager routinely asks the trading desk to direct a small portion of its trading activity to J-Star Brokerage, headed by the brother-in-law. Yeah, that sounds an awful lot like exactly what we're talking about here, some kind of a conflict of interest, potential conflict of interest. All right, brother-in-law. Let's see, J-Star's commissions are above average. Well, that's no good, right? Traders find the research provided to be uninformative. Well, there's a double whammy. The brother-in-law reciprocates this arrangement by frequently recommending our company to all his clients. This arrangement is not disclosed to his employer or clients. Yeah. Has Evans violated this? Yes, so of course, because he fails to disclose. No, because his brother-in-law reciprocates. Well, just because there's reciprocation doesn't mean that we don't have to disclose. And then prohibited from receiving any referral compensation. We don't have any idea about that inside of the question stem. So the answer, of course, is yes, failure to disclose. So that takes us through Standard 6. We'll go ahead and finish up with responsibilities. So do you really want to do this one final time? One final time? Come on, I'm begging you, Jerry. That's what Kramer says on Seinfeld. One final time. Look, just go and spend 5 minutes looking through those 40 questions at the end of the handbook. Maybe you have them all memorized by now, but probably not. Anyway, so after Standard 7, I'm going to have you spend 40 minutes or an hour going through and working through those questions. So I'll see you soon whenever you're ready to watch Standard 7. So, hey, thanks for watching, and good luck studying, and have a great day.